Greetings traders and welcome to Exness Talks, your go-to source for the latest analysis and ideas from markets, plus tips for trading and more. Hello traders and welcome to another episode of Exness Talks. In this analytical podcast, we're going to be looking ahead to some of the key releases that's likely to affect markets over the next few days. And joining us, we have Stanislav Benevkov. Thank you very much, Stan, for joining us for this podcast once again.
Hello, everyone. Hello, Michael. Thank you for having me today.
And the key event in pretty much every market this week is the meeting of the FOMC tonight. So can you give us just a very quick rundown about why this meeting is likely to be important and the subsequent press conference as well? And, what sort of things we might possibly expect in the statement from the Fed tonight?
Well, this is, I would say, the most important event in the financial industry whatsoever. And every type of news, for example, employment, inflation, are monitored by traders with one purpose: to anticipate what the Fed will do. Actually, Fed or European Central Bank, if we're talking about Europe, or British Central Bank. So because monetary policy defines the attractiveness of currency of the country, attractiveness of the debt market, and particularly so it regulates capital flows, inflows and outflows. And having that in mind, of course, it will affect the markets, right? So particularly talking about Fed meetings, they are held 8 times a year, and they are supported by press conference, which Fed's chief makes actually during the announcement. And 2 weeks after, we have minutes, so that's a protocols of voting, and they don't publish it immediately to avoid any volatility, to avoid speculations. But okay, so that's the most important one. Well, usually, if you take a look at the history, you may find out that all analysts are pretty much accurate at predicting interest rates. So, for example, 0.25 is forecasted interest rate for today, and it's possibly will stay at the 0.25 level. So the question is, where is the intrigue, right? Why volatility can come up? And the answer is that traders watch press conference and they hear for the words that Fed governor says. For example, they might say, okay, we see the moderate economic recovery, but we're still concerned about this and this and this. And that might be perceived as a negative signal for the markets, and they might react with a sharp sell-off, for example. Though it might be just words, so nothing unusual, but traders, investors react on what they say. So they try to read between the lines. And that's a surprising fact. I was analyzing those press conferences, those transcripts some time ago. I was trying to figure out, what's the key? What are they saying that affects the market? And actually, that's difficult to say what exactly will be perceived as a negative or a positive outcome for the markets. But still, in case during the press conference, Fed governor says something hawkish, let's say something which might be perceived as a potential tightening of monetary policy in the future. So that might easily drive the stock market and commodity markets down and the American dollar up. In case it is dovish, let's say they say, okay, we see that things are not going very well, so we are going to keep interest rates at the zero level for extended period of time until we see any clear signs of recovery. So in this case, of course, markets might get as a positive signal. So that's a controversial type of information. So on the one hand, good economic recovery is a positive factor for the economy, right? But Fed might consider tightening monetary policy in this case to avoid inflation, and that is a negative signal for the markets. So economy is doing well, markets are concerned about that. So that's how markets actually react on that. So that's a general general take on that. And be careful. Just don't hold positions, through the Fed. If you are day trader, if you hold positions with tight stops. So be very careful with that. Well, as usual, as with any other important news announcement, by the way. So nothing new here.
Mm-hmm. And another key factor that many traders have been focusing on is that the VIX, the volatility index of the S&P 500, has hit a new low this week. So can you explain briefly, Stan, what does this mean for stock markets in particular, and possibly for markets in general as well?
Will suppose that not all traders are aware of VIX because those who trade stocks, for example, they know this indicator called VIX, Volatility Index of S&P 500 Index. Well, it has some pattern. Let's call it a level of fear, right? To understand it more clearly. So the fear is high, the fear is low. So the fear is low, and the VIX goes to the new low. The level of complacency, let's say, increases. Investors and traders are feeling optimistic. So think of VIX as an insurance against the drop, against the meltdown. So, and in case the insurance gets cheaper, so what happens in this case? Of course, people are becoming more optimistic. They becoming more, they make more trades. They tend to bring more trades, and they increase open interest across the markets. And that's usually a concerning point because they create the overbought market conditions. So to continue moving higher, markets have to liquidate the excessive positions to actually, because they cannot move in case they have the massive inventory of long buyers, which are very optimistic. So it has to actually correct before it can continue going higher. So that's why it happens. So if you take a look at VIX, for example, if you take a random chart, I don't know, on trading view, let's take VIX. If you see, whenever VIX reaches the new low, sooner, maybe in 2 to 3 weeks, maybe earlier, maybe a little bit later, the stock market might decline. So we might see the correction for Nasdaq, for S&P 500. And today we have the same situation, right? VIX is at the historical low. Not historical, medium-term low, I would say. Yeah. And it has been at this low for maybe more than 10 days, I believe. So something more than 1 week or maybe 2 weeks. So I think that volatility can be already around the corner. So that's exactly what I'm saying to traders right now. So be aware of volatility. Don't be surprised if you see distribution days, some big red days, or in case you see just an unusual, abnormal daily volatility, intraday volatility. So be very careful. Don't over trade in this situation, because you might see, okay, that's just a normal shakeout created by, I don't know, random event, so I can just get back to my trading and trade as normal. But in case volatility increases, the trading as normal will not work, because all technical levels might be broken very sharply. So it might go beyond any technical level so fast, so you might be surprised why this is not working, right? When the markets are under panic, when they're panicking, so nobody actually reacts on those technical references. So that's an observation. So that's why you have to learn how to trade in the highly volatile environment. Well, the best way is to do that is just to step aside and to not do anything. But if you decide to trade first, you can decrease your trading size, to be very careful, to protect your positions quite quickly, because volatility is a double-edged sword. Markets can go up and down in a limited period of time.
Mm-hmm. Okay. Well, thank you very much, Stan, for these insights. That's certainly very informative for many of us, I think, about the VIX and the Fed.
Thank you, Michael. So good luck, everyone. Trade well, and see you later.
Yes, we hope to see you again soon, all of those who were listening and watching, and farewell.